Accounting for receivables. What is an account receivable? It is identified as an asset in which a customer is yet to provide money to a business after purchasing its goods or services. Now let's break it down in more simple terms. Imagine your friend sells handmade jewellery and you decide to purchase some. You don't have enough money on you, but since you're good friends, your friend will let you pay later. This is what you can call an account receivable. A promissory note is a written promise to pay a certain amount of money on demand or within the near future, formalising a receivable to a company. Accountants must record receivables that occur from a sale in order to identify the parties who owe them and the quantity owed. This can be shown through a journal entry. Since accounts receivables are an asset, the occurrence of a sale will increase it, placing it on the debit side, whilst the increase of revenue will place it on the credit side. Most businesses expect to collect their accounts receivables within a month or two, but this isn't always the case. A way to deal with this is through the accounting principle of conservatism, which affirms accountants to implement methods that is least likely to overstate assets and revenues or understate expenses and liabilities. But the most useful tool is the net realizable value. This is the amount of cash that a company can expect to collect from its gross balance of accounts receivables. Uncollectible receivables, however, are when a business is unable to collect all owed expenses and must record them as bad debt expense. The direct write-off method is when bad debt expense is recorded when a company identifies that a receivable is uncollectible and eliminates it from its records. Its main advantage is its simplicity. However, its disadvantage is that it violates the matching principle. On the other hand, the allowance method consists of either recording an estimate of bad debt expense or recording the recovery of a write-off. The purpose of recording bad debt expense is to match the expense associated with the uncollectible receivables to the period in which they were produced at the end of each accounting period. As for estimating bad debt expense, companies can either use percentage of sales approach or percentage of receivables approach. The aging of accounts receivables is a more refined version of the percentage of accounts receivables approach, as it recognises that the older the collectible is, the harder it is to attain. Thank you so much for watching. Now I know that I wasn't able to cover everything in detail, but I hope this has helped your understanding on the topic of accounting for receivables.